Okay, welcome to Trader Tuesday. Today's the 4th of June, 2024, and our special guest, Jay Bailey. Jay and I worked together for about 6.5 years. That's how long I was at Sheridan Mentoring, but
Yeah,
I was a student at Sheridan Mentoring in 2006, I think, and built Dan's member site, and then ended up the following summer 2007 working for Dan. And at the same time, Jay was a mentor there. So Jay and I know each
yeah,
other quite well, but I
yeah.
left Sheridan Mentoring in November 2013. So it's been 10 years since we've worked together, but it's really great to have you back. And
Thanks.
Mark Fenton was with us both, and Mark is also at Aeromir now. So it's kind of like the old crowd's coming back together.
Yeah,
So
it's great. It's absolutely great. Yeah, I think I started working with Dan in maybe 2007, late 2007, sometime around there.
mhm.
And I think, uh, I think it was maybe a total around 16 years. So I stayed a little longer than you did. But it was a good association, and but all things, I guess, come to an end eventually. So, glad to be here today, and thanks for the invite. I really appreciate it.
Well, you've had an interesting journey for sure. So I know when we were working together, you were up in the Boston area, I think, and doing
Yep,
engineering and then mentoring part-time. But how did you
right.
get into option trading and the whole mentoring thing?
It's interesting. I think my wife actually got me initially interested. And I had been trading stocks for quite a while, probably 7 or 8 years at that point, even doing some shorting, but I had never done anything with options. And she got an invite to, I think it was an Invest Tool seminar, right?
Oh, right.
You remember them? I think they're out of business now. I think they got bought up by somebody, and then I heard they went out of business in late, I don't know, 2015, 2017 or something, but or they got shut down. I'm not sure what the deal was. But anyway, I went to one of their seminars and, did some of their education. I found it really interesting. It kind of went along with my background of computer science on the logical and technical side, and I'm also an MBA, so the business and financial side was interesting. So I found the whole thing really fascinating, and really got into it. And so yeah, so I've been trading options since certainly probably late 2006, early 2007.
Yeah, it's about the same time I started, I think. Well, I guess my first option trades were back in '82 when I was in college.
Oh wow.
One of my teachers in Chicago, I was working for the post office during the day, delivering mail at night. And one of my night school teacher was a market maker at the CBOE, tried to get me a job as a runner twice, didn't work out. But yeah, that kindled my interest in options way back then. So
Oh wow. Yeah, you got started a lot earlier than me then. We're about the same age, I'm guessing.
I think
Uh,
so. I just turned
yeah.
64.
Okay, you're a couple years older. I'll be 61 next month. So
Okay. And then Dan
actually
Sheridan
July,
and I
not
have
next
the
month.
same birthday, but he's a year older. So he just turned 65.
Great. Yeah, so I remember when I first started trading options, because 2007, I was doing a lot of mostly iron condors, and it was a great year for that. I remember having it was either 10 or 11 months out of 12. I had winning months, and I was like a lot of people. I think when you start out, I was probably trading much bigger than I should have been. Really had a plan, but I didn't know a lot about position sizing and really good risk management at the time. So of course I thought it was a genius, right? Because I'm winning 10, 11 out of 12 months doing monthly trades. Um, and then I guess 2008 came along, right?
Yep.
So that market was a good, especially late in the year, was a great teacher, right? So you learn that you don't know what you don't know, right? And so, in a way, I feel like I was lucky to start seriously option trading during that time because I was there in a really good market in 2007. That was this, I don't know if you remember that summer, but it was kind of like that summer was watching paint dry. You'd watch the SPX and the rut go up and down, sometimes less than 50 cents a day.
Right.
So it was pretty non-volatile, right? And then 2008, of course, just the opposite, with VIX going to what it was 80 at one point.
Right.
Um, and so just to say, I learned a lot in the first couple of years. I don't know if we've ever, well, I'm certain we haven't seen a market like 2008 since then. We've seen a few,
Few attempts.
few month wonders, but nothing quite that bad, right? So,
It
yeah,
reminds me of my eighth grade teacher. She said the only questions you usually remember on a test are the ones you got wrong. So our
yeah,
losers can teach us a lot.
they certainly do, and certainly that was the case for me. But yeah, so I've enjoyed it along over the years, and then I actually started doing some mentoring before I joined up with uh, Dan Sheridan, and I mentored, had my own students for I don't know, maybe 9 months to a year, and was doing some teaching and enjoying that. And also, I ran I co-ran an invest tool trading group, which had over 100 members in the Boston area, and really enjoyed that. It's always, trading is kind of a lonely business if you're just doing it by yourself.
Right.
And so it was enjoyable to, work with some other people, meet some other people, trade together, swap ideas and all that. And of course, that's what a site like yours is about as well. And I think that's really key because you get kind of stuck in your own head after a while, and it's good to have feedback from other people, I think, like anything. So,
Yeah, definitely helps.
yeah, but I think uh, over the years, I've really kind of enjoyed creating trading systems and strategies once I really got into options and more advanced options. I really like doing that, figuring out what's the best risk management for the type of trade I was doing. And there is no best, but there's better and there's worse, certainly. Um, like I remember early on in my career, I saw probably 25 different ways to trade iron condors, and probably 20 of those weren't so great, right? So there's definitely better and worse in terms of trading strategies, but I haven't always enjoyed creating trading systems. I've done a number of them over the years. Um, a lot of back testing, forward testing, live testing, all that kind of stuff before I would roll it out. Um, but I've always been a believer in really kind of complete systems because I saw a lot of stuff early on where the plan was put on a position and then maybe somebody defined one adjustment or maybe none. Maybe the only risk management was just taking the trade off at the appropriate time, whether it's a winner or a loser. But I always found that for me at least, and for most people that I worked with over the years, it was better to have a complete system so you know from start to finish when do I put this trade on? What's my vehicle that I'm going to use for the trade? What's my initial position look like? What are my adjustments? Which might be one, might be two, might be 10, right? And then what's my exit strategy so that I'm not sitting there looking at the screen going, okay, what do I do next? Or which of my 10 different adjustments should I do next, right? I've always found, for me anyway, my personality, I work better with, a plan that's pretty well defined. Not that I never would, do something a little different, but structure works for me, right? And I find it works for most people too, especially earlier on in their trading. If you don't have that structure, you tend to go off the rails and do weird things. So, because you think this time is different than every other time, right? Somehow,
Right.
but it's usually not. So,
Yeah, my mom had a college professor said rules are made to be broken, and
yeah,
but you have to have the rules, like you said, just to start.
yeah. I just find the structure is important. Otherwise, emotions tend to take over, right? For a lot of people, and the structure helps calm that rather than sort of flying by the seat of your pants, I find.
Right.
So, and I've also found, of course, when you start trading, you're just learning what the basic strategies are. Okay, what's a butterfly? What's a condor? What's a calendar? Uh, and I found I know people have success, just doing those trades without any adjustments and very little risk management other than, a profit target or maybe loss target. But I have found for me anyway that I'm a definite believer in adjustments, right? The market moves. And if you can design your trade so that it will kind of follow the market around while keeping your risk under control, for me, that's the best of all worlds, right? Um, and so I learned early on that adjustments for me was the way to go. Um, Maybe to a fault sometimes. I've had some trades I've been in where I've adjusted it 15 times, and that's probably excessive. But
Yeah.
certainly, a good number of those are still winners, right? So, it's and that leads me to another thought, Tom. And I don't know if you've seen this. It's kind of I guess, I call it a dichotomy I see with a lot of people trading. I found two things that were sort of diametrically opposed when I work with people. One is, they hold on to a trade too long, and two is they don't stay with the trade long enough. And those sound like, opposite things, but I found both to be true. Because it's okay to be holding onto a trade through a lot of adjustments if you're managing the risk and you're not, you know, getting to a point where your risk is getting out of control and going way beyond what your defined maximum loss is. But the other thing is I see people giving up too early, and that, they have a couple of adjustments and they just get like, oh, I'm just going to get out. And if they just stayed with the trade another week, it would have been a winner, right?
Mhm.
It doesn't
Right.
take very, very many of those to turn your expectancy into something that is not favorable, right? So,
So you were doing iron condors at first, and then
yeah.
how has your trading evolved since then?
So most of my bread and butter stuff that I like to do is butterflies, iron butterflies, calendars, both short and longer term stuff. Um, I still like to do credit spreads for directional. Um, I'll still do some condors as well. So and a few double diagonals here and there too. So I like a lot of different kinds of things. I don't feel like I need 10 different trades, but probably have five or six that I do that regularly. And I guess cash secured puts have been quite a bit of that over the years, mostly in stuff like VTI, that Vanguard Total Market Index ETF. So, those are kind of my bread and butter. I haven't gotten into, and I know last few years, a lot of people have gotten into the really short-term trades, zero DTE and stuff like that. Uh, I've looked at that a little bit. It's not something in my comfort zone yet, so I tend to do things that are 7 days or longer. Maybe seven up to maybe 50, depending. My long-term trades, usually it's 7 to 35, 40, but sometimes 50. So, that's where I'm at. I haven't done a lot with futures only because I find that the option stuff keeps me entertained and busy enough. So,
Right.
uh, I don't feel like I really need to do that, but I know a lot of people do. So, I would say I find the diversity in having 4 or 5 trades is useful. Um, I've always been a big proponent of looking at the range of the VIX or whatever your favorite volatility index is, and saying, okay, where are we? Are we sort of in higher range or lower range? And then tailoring my trades somewhat to that. When I say somewhat, I'm not a big fan of sort of going guardrail, what I call guardrail to guardrail, which is, okay, VIX is quote unquote low. You can't see my air quotes, but quote unquote low, and I'm going to do, all calendars, or it's high, I'm going to do all um, iron condors. And the reason I don't really like that is because I think it says, I know where volatility is going, right? If you're just doing Vega positive trades because you believe the VIX is low and not going lower, you're picking a direction really. If you think about it on volatility, um, and most people aren't that good at picking direction on volatility or anything else. So I find it, keeping that mix there of say Vega positive, Vega negative trades really all the time, and just adjusting the ratio works best for me because I'm often surprised. I think, okay, I'm going to put on a butterfly and a calendar, and I think the calendar is going to do better based on what I look at. And it's just the opposite sometimes, right? The butterfly does better, calendar does worse, even though the setup looked like the calendar would do better. So, I like to keep that diversity in my trades because I just think, I don't know, I'm not smart enough to pick the direction of volatility. Um, and, my experience is most people aren't, right? So,
So you're mostly trading butterflies and calendars these days.
butterflies, calendars, I still do credit spreads, and iron condors as well. So those 4 or 5 trades, and some cash secured puts thrown in along the way for good measure.
Let's see. I had some questions here. So I guess how's your approach to risk management evolved over time, would you say?
Yeah, I think one big thing is I'm actually proud to say because I spend some time on for entertainment purposes mostly. I don't know if you've been on the options um, subreddit on Reddit, which
No, I
is
haven't been there.
yeah, it's full of mostly beginner option traders, and I mostly read it for entertainment purposes because talking about not knowing what you don't know. Um, I see so many people just, coming on and saying, "Oh, I blew up my account. I put 10,000 in my account and now I'm down to $500 and I don't know what to do." And, um, it's both entertaining and a little sad, right? But I'm proud to say I've never blown up an account in all these years, right? Certainly I've had losses. Everybody has losses, but never blown up an account. And that's because 2 reasons, I think. One is have had some reasonable discipline, especially after that first year, on trade size. Looked at risk of ruin and said, well, I'm not going to put more than 3 or 4% maybe of the account in one trade. And I typically am not doing a large percentage of the account in options either. So, I've been, I'm sure some luck is involved, but I've been pretty good at managing the size. And also, I think having the trade plans, and I've refined those over the years. Obviously, they change over time, slowly with the market, but not too quickly. But I think those 2 things have really helped me to, manage the risk. And I think there's a third thing I think is really important. And I don't see it that much. And that is, several years ago, I developed um, what I call a large down move strategy, right? And I personally think everybody that's trading options should have something like that. And so, when you have very large moves in the market, unexpectedly or otherwise, you need to have a reaction. And usually people are reacting too late. And so I put some parameters around that through some testing and thought around it and said, when I have a certain size down move in the market, down moves are always, almost always more dangerous than larger up moves. Um, I'm going to do something at a specific point, and I follow that pretty religiously. And I had I think when I first started working with Dan, I hear Dan say to people, I think his phrase was "buy the stinking put," right?
Right.
And
Nothing, nothing like a
it,
long put as your friend on the darn market, right?
yeah, but me being someone analytical, that wasn't quite enough for me. It was great advice, but my mind went to the next 6 questions, which was, well, wait, which put do I buy? What delta should it be? How long should I keep it? When should I sell it? ad infinitum, all these questions, right? So then I said,
Right. And what
well,
if it goes against me? Should I do a
right, when do
spread
I
instead? Yeah.
exactly? So I set about designing a set of guidelines to tell me the answers to all those questions. And I found that extremely helpful over the years in terms of risk management, because if you do it as a matter of course, and I will tell you, even the way I do it, probably 80% of the time, when I buy that put and I, sell it when my guidelines say I should sell it and all this stuff, I'm going to lose money doing that. It's not a lot, but it's probably not going to benefit the trade. But the other 20% of the time, it saves my bacon, right? Because it's not just this one day down move or something. It's a
Right.
sustained, move, which if I didn't do it, I would have lost many times, where I lose, having to put in place. So I found that to be pretty key to risk management. Have a large down move strategy that's, somewhat, pretty well defined, and stick to it so that you do it on a, pretty religious basis. I find helps a lot and helps you sleep at night too.
That's important. Bill asked, does Jay trade indices, stocks, or futures? I know you said you don't trade futures.
I don't trade futures. I trade stocks from time to time and credit spreads, but mostly I'm trading indexes, SPX and Russell, primarily. IndieX a little, but not as much.
And Bill asked, are you going to be active at Aeromir? I hope so.
Yeah, Tom and I started to talk about that. It was great that Tom kind of reached out to me out of the blue, and was happy to hear from him. And I'm definitely considering that. I'm kind of I'm still doing. I went back to work for a major healthcare company doing um, some revenue strategy and analytics for them, and I'm still doing that. I'm trying to stop doing that. Like I tried to leave. I was going to leave last year, and then my manager said, "Oh, here's this big bonus to stay for another year and a half." It's like, don't. I want to retire. So, but it's hard because I moved. You talked about I was in Boston, right?
Right.
I moved to the coast of North Carolina, down here in Hampstead, North Carolina, a lovely place. And my commute is 10 feet from my bedroom to my office, and they don't
I
bother me
love that
much.
commute.
Yeah, it's great. And they don't bother me much, and I get to do stuff I enjoy, and my management is really, really great. So I haven't retired yet. But now I've forgotten your question. I got off on a tangent.
Oh, are you going to be active at Aeromir?
Oh, right. So, um, when I don't want to retire and do nothing. And so I definitely am looking forward to, starting mentoring again. I haven't been mentoring for about 6 or 8 months now. And yeah, I'd like to start again, or, doing something with a trading group or something like that. So yeah, Tom and I are going to talk about that, figure out what it should be, and, want to stay involved. People often ask me, over the years of mentoring, and I see this on the options forum too that I was talking about earlier. Why do people teach trading? Why don't they just trade full time and do nothing else? If they can make money trading. It's like, well, okay, but like I said earlier, it's a lonely business. If you just sit there and trade all day and don't talk to anybody, it gets really boring after a while. And I enjoy interacting with other traders and students. I enjoy that a lot. So um, for me, it's about that. I was never doing mentoring full time over the years. I was doing, maybe 5 or 6 students a week, and that was perfect for me because, I enjoyed being involved with it, enjoyed the teaching aspect of it. But yeah, I definitely want to do something with you, Tom, and we'll figure out what that is soon.
Well, I remember, as far as me for teaching, I also find that the teacher typically learns more than the student. When I was teaching
That's
people how to
true.
fly, you want to do a fix to fix, a point to point, and there's like two or three different ways to do it, and you have to know all of them to teach a student. until the best one for him or her clicks, and then they've got it. But you had to know all of them. So it really
Yeah,
made
that's
it.
very true. I learned a ton. If it's nothing more than just an idea, where the
Right.
student says, "Can we do it? Can we do it this way?" And I'm sitting there thinking, "Well, I never thought about that before. That might make sense. Let me think about it." Right? So, yeah, absolutely, that often happens.
And I've
Um,
also found that sharing, a lot of people they have an idea and they want to keep it close and not share it. But I found when you share, other people jump in and give you other ideas and maybe try and improve it. So
mhm.
I found that sharing and interaction is very valuable.
Oh, definitely. I've definitely found I've seen, it's kind of funny though. I see both sides of that over the years. It's definitely helpful, but I also see this human, I guess it's a human nature tendency where, I'll work on a trading strategy, maybe from, months, right? And I'll think about it, I'll refine it, I'll test it, back test it, live test it, and then I would teach it for the first time. And before somebody ever traded one of these, this well-tested plan, I would get, well, can you do this instead? Okay, sure, but maybe you want to try it once, at least once. But yeah, like anything, whether it's in the corporate world or the trading world or wherever, uh, I think we always benefit from different opinions and ideas, rather than sitting in a vacuum trying to, determine everything yourself.
Right. A few more things came in the chat. Mark Alpers wants to say hi.
Oh,
That
hi.
that name, I remember that name from a long time ago.
Oh, yes, me too. Absolutely. Hey, Mark.
And then Joe asks, "What are your thoughts on synthetic covered calls for some income?"
Um, you know, I I've done covered calls in the past and synthetic covered calls to what we call, and sometimes poor man's covered calls, right?
Right. Yeah, like an
Um,
80 delta call. Yeah.
yeah, I tend to like that better than sort of a standard covered call. In other words, with stock and selling the call. Because to me, in my analysis of it, a covered call strategy is really just an equity smoothing curve strategy for the most part. In other words, when you sell a covered call, you give up the upside, right?
Right.
You gain the premium. You may keep it 1 month, you may not, or depending on what happens with the stock. But overall, I think it's more of, if you looked at your equity curve of just buying the stock versus doing the covered calls, I think over a long period of time you'd find they're about equal. Now, maybe if you're selling way out of the money calls and you never get hit, and you could add a little bit to the top end, maybe that's okay. But so as far as doing them, though, I think with the synthetic ones, obviously a lot less capital being deployed, um, which is good. So if you can manage your long-term part of that, the leap, assuming you're doing leaps with it, well, I think I think it's a pretty good strategy because you're getting more out of it yield-wise than you would get with a stock. However, the one thing I would be careful of right now with those is, people don't, there's one Greek that nobody ever talks about, which is rho. And for good reason, because it usually doesn't affect much. But the one time it does affect, especially leaps, is when interest rates are being cut. So if you own some leaps and you start to get some interest rate cuts in, the next 6 months or whatever, you could have material effect there on your long options. Row will actually affect you. I like to joke over the years. Nobody's ever asked me to teach them that row neutral strategy, right? That's never happened. Um,
Right.
but it does have an effect, especially with the leaps when interest rates are going down. So I just be careful with that if you're going to get into that. I don't know
And
how we
Charles
predict. Yeah, go
Charles
ahead.
asked a question about your large down move strategy. Does that allow increased size? I guess for your other trades.
It's really not about increased size. It's really about, for any trade I do, any of that list I talked about earlier, I built guidelines around what's the market move that will cause me to buy a put. And based on the size of that trade that I'm buying the put to protect, whether that's a butterfly or condor or calendar or whatever, which put am I buying? In other words, how much of the delta am I cutting on the trade is typically the question. And then for that put, I buy it. Okay, what typically happens with people is if they do buy a put on a bigger down move, um, let's say, okay, so when does this happen? Well, it happens at the bottom typically of a big red candle, right? So you buy this put, and then the next day you get a green candle, and let's say it goes halfway up the red candle and recovers halfway. Then they get looking at the put and they say, wow, I'm losing money on this put. And then they sell it. And that's typically the wrong move. So I define some rules around when do I sell the put, right? And I think it helped me a lot because then I have a very, you focused strategy on how I deal with that. But it's not really about increasing trade size. It doesn't change what I do. Was it Charles you said asked that question?
Yes.
Yeah. So what I do, Charles, is um, I kind of suspend my normal rules for my adjustments for that trade when this happens. I'm buying my put and I'm sitting there waiting to see what the market's going to do. And one of the guidelines around this is until that price goes back above the top of the candle where I bought the put. Now, remember, it's going to be a big red candle typically, right? Until the price exceeds the top of that candle, I don't sell it. And that might be a day, it might be a week, it might be 2 weeks, right? Could be a while, might be never. But I find that a large percentage of the time, if I wait that long, yes, I lose a little bit more money on the put, but guess what? I'm now probably in the back in the center of my trade where I can make money. Then I'll sell the put at that point, and I could sit there and potentially recover that, at least cover that, or maybe even make a profit. So, and again, like I said earlier, probably 80% of the time, that's a net loss in terms of just the put itself. But the other 20%, I'm glad I did it. Um, so
And speaking of interest rates, on the Thinkorswim risk profile page, their P&L's been off for a couple of months on the chart, so it helps if you put in 0% for the interest rate. Just a little tidbit
mm.
there.
Speaking of
Then Kev,
charts
yeah,
being off, have you noticed the positions in some stock quotes have been wrong well, certainly yesterday.
yeah, it was a
Um,
Berkshire Hathaway down like 99.97% at one point during the day yesterday.
yeah, I don't know about Berkshire, but I have in some of my long-term accounts, I have NUSI, which is an option enhanced, I think it's by Nationwide, it's an ETF. Um, and the bid was 11 cents and the ask was 23 something.
Oh,
And so of
wow.
course you get the mid between and it showed my account way down because of that just incorrect quote. And I was telling my wife, I said, look at this. She said, oh, our accounts are way down. I said, actually, they're not. I said, this bid and ask cannot be right. So I called, well, my accounts moved from, TD Ameritrade over to Schwab. And so I called or went to chat with Schwab, and they said, yeah, there's about 30 symbols that we're not getting any valid quotes for today. And
Oh,
NUSI
wow.
was one of them. So it was weird because now today the quotes are back to normal. So it shows my P&L day is like way up because it was supposedly down yesterday. Neither one of which are true. But
That's funny.
anyway, yeah.
Oh, and Kevin had a question. When putting on butterflies, how do you choose between placing an iron fly versus a standard fly?
Yeah. To me, in terms of the actual risk reward benefit and all that stuff, there's really not any difference or not a lot of difference, but I use iron flies for a couple of reasons. One is I just like the way the adjustments that I use work better with iron flies. And the other thing that happens with a classic butterfly is sometimes you can get legs very deep in the money. Um, and then they can be hard to get off sometimes if they get deep in the money. Whereas typically with my iron fly, if I'm moving, let's say one side out further, the other side out further, neither side gets really deep in the money. And so it just makes them easier to take off many times. But other than that, from a practical purpose, there's not a lot of difference I find. So
Okay, well, we usually go about half an hour, so we're a little over, but
yeah,
that's fine.
oh,
Just
great.
a couple more questions. What tips would you give to someone who's just starting out with option trading? I know Charles Cottle's advice was stay really small, which I think is great, but do you have any other advice you'd give people?
Yeah, that's a really real. I mean, and I'd say start small, and I'd say grow organically. So what do I mean by that? So I remember early on when I was trading, and I was doing a lot of condors, and I had some trading partners. People would say, why are you trading 37 condors in this account? Why 37? No, instead of 30 or 40 or whatever. And I said, well, that's because, I probably traded 35 last month and I had a win. My account grew by X amount. And so my calculation in my little spreadsheet said, now you can do 37, right? Or if I lost last month, maybe I'd be doing 34 or 33. And I think it's a little bit harder when you're starting with maybe one contract, but try to do that. Don't go from 1 to 5 to 10, right? Because inevitably, you'll probably do well on the ones and the twos and the fives, and you get to 10, you'll have your first big loser. So, try to grow it a little bit organically, even though it's more difficult when you're small. I think that's important. And certainly whoever said size is, absolutely right. Keep it, trade as small as you can possibly trade until you're comfortable. And I would say, comfortable would be you're trading in, an up market, a down market, a flat market, and you've done maybe at least a dozen, right, before you ever increase your size at all. Um, and have a plan, right? Have a plan so you know what to do, regardless of what the market does, whether it's doing what you expect or what you don't expect. Make sure you know what to do next, and you're not making that up on the fly. I just find for especially for newer traders, that's really key because otherwise something happens, you go, oh, I didn't expect this. Then your emotions take over and you do something silly. So yeah.
One mistake I made too is I stayed as a sim trader for a long time, and
Mhm.
you got to dip your toe in with some real money because you don't get
Yeah.
the fear, greed, and all that stuff without it.
Agreed. Not only that, I think you don't get the fear of the greed, but you also, typically all the platforms I've seen for simulated trading, they're not quite, the fills aren't like what they are on, real trades, right?
Right,
You're
right.
going to have more difficulty typically on a real trade getting filled. So you got to get used to that. I think that's pretty key too. Having patience on your fills. When you can. Like I say when you can, because sometimes, if you're doing an adjustment, you need to do something rather quickly sometimes, but all other times, you should be really patient in getting your fills. Um, you know, uh, and of course, be careful that you're trading, fairly liquid vehicles. Um,
Right.
you know, Obviously, if you're doing indexes, they're going to be pretty liquid, or big ones are, or something like SPY or IWM, very liquid. But even there, you can go to a short number of days to expiration and maybe an odd, five strike or something like that instead of a 10, and you can get very low open interest and be hard to get filled. So that's another thing to look out for. And don't do market orders. Well, no, never.
The only time I like to make market orders is if the market's crashing and I have to get something filled, like buying a put.
Yeah, yeah. Those times you may have to, but other than that, I think I could count on one hand the number of market orders I've done in options in the last, since I started probably. But a few times, you're right. When the market's crashing, you just have to do that.
Yeah, despite the bullet.
Yeah.
Just two more questions and then we can wrap it up. But Charles says, speaking of row, at least one option risk profile software shows potential loss for put calendar greater than the debit paid if it moves deep in the money. Can you comment on that?
No, I don't think I can because I'm not sure I understand what you're saying.
Okay, so he's showing a potential loss on a put calendar greater than the debit paid. I guess the volatility must be changing. I don't know.
Yeah, that's interesting. I've never, contemplated that, so
Yeah, it's
I'm
could be
not
a
sure.
glitch in the software, I guess.
Yeah, I don't know. That's
And then
interesting.
Bill asked, how much cash buffer do you keep? Like, what percent of your account are you actually trading, would you say?
Yeah, like I said earlier, I'm pretty conservative with that. So, I'm always less than 50% of the account. And of course, I have to have funds for adjustments, right? Because in some of my strategies, when I make an adjustment, the size of the trade grows. Now, I don't, I try to limit that. I do limit that, but I'm accepting some size growth, so I have to have some cash available for that. But yeah, I'm typically less than 50%.
All right. Well, I think that should do it. So thanks, Jamie. It's been really great to get to know you a little bit better and especially for people who aren't familiar with you. But I look forward to when you come up with an idea to participate more, either mentoring or a service or a class. I'd be more than happy to have you here at Aeromir. So, and you're always welcome to participate in the trading groups and all that, of course, too. So it's
Oh,
a
thanks, Tom.
really great to reconnect, and I'm happy we actually got together again.
Oh, feelings definitely mutual. I want to talk to you more about some other subjects other than options too. I know Tom and I are both at least dabble in photography, and so we'll probably have some conversations in that area as well.
Sure.
But thanks again, Tom. I really appreciate it, and good to talk with you and your audience.
Yeah, thanks everyone, and we'll see you next time. Thanks,
All
Jay.
right, bye now.
Bye.